Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
The market has not stopped with its white knuckle movements, though, and just today we are seeing much more concern around banks and a bit of a flashback to the spring of 2023 when regional banks there experienced a crisis. We can see that the fear gauge, as expressed by the VIX, is at its highest level since April. The concern focused on Zion Bank and Western Alliance and a suggestion that these banks were exposed to bad debts and perhaps there have been sloppiness in due diligence in credit checks. This, of course, smacks very much of the type of concern around regional banks that was in place at the beginning of 23. At that time, it centered around the exposure to commercial real estate, and there was also concern around SVB and concentration of clients. I think it's important to step back and take a look at the US regional bank market. It is a somewhat fragmented market and is unusual on the global sphere, as globally, for example, in the UK or Europe, there is not the same chain of regional banks. There's much more concentration in a few large banks. And post-COVID, those banks have continued to consolidate, and some of them could in effect be too large to fail. And that would be the same for many of the US large bulge bracket banks. When it comes to regional banks, they are more exposed. Some are more exposed to certain sectors, certain types of lending, such as SME lending, or in the case of SVB, certain types of clients that were perhaps used to a concierge service, but did act as one when there was a desire to redeem from that bank. So diversification by client type, by lending type is definitely key in the banking sector. Regional banks don't always display that kind of diversification. So concerns about the health of that have naturally trickled through into the entire financial sector. And that has been a drag on markets so far today. So we'll be continuing to watch that because of what it may potentially tell us about the state of credit markets and its health. Looking at some other factors across the equity markets, an indication that perhaps despite valuations being quite toppy previously, that price to sales is now getting quite high for the S&P, and we've got some more charts later to show exactly the same thing. Price to sales now getting ahead of 3 times, suggesting that it might not perhaps be the bargain that we would have said it was before. And looking at a segment that often gets overlooked, maybe doesn't have the most amplified voice, farmers. When it comes to soybeans, we've heard about the precipitous fall in demand for soybeans in the US because of China essentially switching its import of soybeans from the US to Brazil. This chart here just shows how sudden and severe the uptick in imports from Brazil was for China. And even though there is still a reasonable amount imported from the US, that amount could very likely fall over time. And soybean prices have responded in kind. The bottom left shows the price of US soybean futures lagging the Bloomberg Spot Agricultural Commodities Index badly. So a double whammy for farmers, no demand, and therefore prices following suit. So this is something, of course, to watch because it will no doubt have to be accompanied by some subsidies, some compensation to farmers who are enduring this. And it also creates a spectre of a reorganization of the world trade landscape according to the new set of rules. And this, of course, is something that we will have to keep watching carefully. Moving from white knuckles to cockroach moments, and we have Jamie Dimon to thank for moving us beyond the canary in the coal mine metaphor into now thinking about cockroaches, less palatable to some perhaps. His cockroach metaphor was referring to the spectre of 1 or 2 bad incidents, such as in the case of First Brands and Tricolor that we mentioned last week, being just like a cockroach, and that when you see one, there's rarely only one, there are often more where they came from, suggesting that even though in his case JP Morgan was actually implicated in being one of the lenders to First Brand, that there is probably a sign of a greater malaise in the sector, other due diligence shortcomings, other promises that cannot be kept. That has not yet been reflected in default rates. As the chart on the left shows, both leverage loans and high yield bonds have seen considerable downturn in default rates, nowhere close to their peak. This is the norm. There are still bad apples among that. And getting back to the root cause of why this fraud was not seen, and why it was essential. There was so much broad-based exposure in the CLO market as well as the private credit market more broadly. A suggestion here in the Financial Times from an executive at a former lender to First Brands had said, "You're not paid to do due diligence in this market." That is quite a chilling admission. If there is simply not enough margin to pay for basic due diligence, which could have averted at least many of these banks being exposed to that. This begs the question as to whether the crowding in the market has driven down returns to a point that there is not enough excess available to conduct basic due diligence checks. That is surprising somewhat and makes me wonder at what price one does consider they are paid to do due diligence. So again, as interest rates come down, and the private credit segment is a segment that will have a much more sensitivity to rates because it's floating rate. Their returns will come down as the interest rates come down. We need to see whether there is enough left for due diligence, and when we conduct our own due diligence on private credit firms, this is definitely a question that we need to be asking.